Risk management in volatile markets is not an advanced topic reserved for professionals. It is the very first skill that decides whether you will still be here long enough to become one. Because volatility does not destroy accounts by itself. It exposes every weakness in sizing discipline and expectation that was already there. I learned this lesson repeatedly across market cycles, from the dot-com collapse to the 2008 crisis, and again during COVID, and every time the message was the same. Even though the circumstances looked different when volatility rises, the market stops forgiving sloppy behavior. And anything that was slightly wrong in calm conditions becomes brutally obvious. Most beginners think risk management means using stop losses, but that is only the surface. Stops are execution tools. Risk management is a mindset and a structure that exists before you ever place a trade. In volatile markets especially, the question is not where do I get in? It is how much damage can this idea do if I am wrong and the market moves faster than I expect. Volatility compresses time. Moves that used to take days happen in hours. Pullbacks that felt manageable suddenly feel violent. If your risk is designed for yesterday's pace, today's market will overwhelm you. The first principle of protecting capital in volatility is accepting that volatility changes the rules of engagement. In calm markets, precision is rewarded. Tight stops, exact entries, and frequent trading can work. In volatile markets, precision becomes fragile. Price jumps levels. Liquidity thins. Stops get skipped. Traders who keep trading the same way through regime changes often say the market is crazy, when in reality their behavior failed to adapt. The market is not obligated to slow down just because you are uncomfortable. One of the most important shifts I ever made was redefining what opportunity means in volatile conditions. Beginners see volatility as more opportunity because price is moving more. Professionals see volatility as more risk, first opportunity second. Big moves attract attention, but they also attract forced liquidation, algorithmic cascades, and emotional crowds. If you don't reduce exposure, volatility multiplies your mistakes faster than it multiplies your gains. Surviving volatility requires humility, not aggression. Position sizing is the cornerstone here. In volatile markets, your size should almost always come down, sometimes dramatically. This feels counterintuitive when potential profits look larger, but this is exactly why so many traders blow up during crises. They size for excitement instead of survivability. The correct size is not the one that maximizes profit if you are right. It is the one that allows you to stay rational if you are wrong multiple times in a row. Volatility increases the probability of consecutive losses. If your sizing cannot tolerate that, it is not risk management, it is hope. Another core concept is risk aggregation, something beginners rarely think about. In volatile markets, correlations spike. Trades that look diversified on paper start moving together. You think you have 5 different positions, but in reality, you have one big bet expressed 5 ways. When volatility hits, everything moves at once, and suddenly, your total exposure is far larger than you realized. Protecting capital means looking at risk at the portfolio level, not trade by trade. If all your positions would lose money in the same scenario, you are not diversified. You are concentrated. Drawdown limits become non-negotiable in volatile markets. You must decide in advance how much pain is acceptable before you change behavior, not just feel bad. This might mean cutting size in half after a certain drawdown, reducing frequency, or stopping trading entirely for a review period. These rules are not about giving up. They are about preventing temporary stress from turning into permanent damage. Volatility punishes those who believe they can think clearly under unlimited pressure. One of the most dangerous psychological traps during volatility is the urge to make it back quickly. Fast markets create fast losses, and fast losses create urgency. Urgency leads to revenge, trading oversized positions, and abandoned plans. I have never seen a trader recover a drawdown sustainably by speeding up. Every meaningful recovery I've witnessed came from slowing down, accepting reduced activity, and letting conditions stabilize. Volatility demands patience precisely when patience feels impossible. Another key element of risk management is expectation control. In volatile markets, outcomes widen. Bigger wins are possible, but so are bigger losses and longer drawdowns. If your expectations are still calibrated to calm markets, you will feel constantly disappointed or pressured. Adjusting expectations is a form of risk management. Lower targets, fewer trades, longer evaluation periods. When expectations align with conditions, emotional stability returns. Liquidity risk also becomes real in volatile environments. Orders do not fill the way you expect. Slippage increases. Stop losses do not guarantee price-only exit. This is why relying solely on tight stops for protection is dangerous. Risk must be controlled primarily through sizing, not through precision. Precision fails under stress. Size survives it. Over time, I noticed that traders who handled volatility well shared a common trait: they were comfortable doing less. They traded fewer setups. They passed on obvious moves. They stayed in cash more often. Cash is not a position of fear in volatile markets. It is a position of optionality. When volatility is high, having the ability to wait is one of the most valuable edges available. And this is where the conversation needs to continue, because understanding these principles intellectually is not enough. The real challenge is knowing exactly what to do, step by step, when volatility spikes, how to adjust size, frequency stops, and expectations in real time, without freezing or overreacting, and how to protect both your capital and your confidence, while the market is moving faster than your emotions can comfortably process. And that practical framework is exactly where we need to go next, as we move from understanding risk management conceptually into applying it mechanically in volatile conditions. Because volatility is not the time to invent rules. It is the time to follow the ones you prepared in advance. And that continuation is where we pick up next, as we carry this thought forward into the specific, actionable rules that keep traders alive when markets become unstable and unforgiving. And the difference between survival and ruin is decided not by intelligence, but by restraint and preparation. And that is where we continue next, by shifting from thinking to execution rules that activate automatically when volatility rises, because volatile markets are not the time for judgment calls, they are the time for pre-committed behavior. The first rule I rely on is automatic risk compression. The moment volatility expands beyond my normal baseline, measured by wider daily ranges, faster swings, or abnormal gaps, my position size is cut immediately, usually by half, sometimes more. This is not based on fear or discretion. It is mechanical. Volatility means uncertainty has increased, and uncertainty demands smaller bets. If you wait until losses force you to size down, you waited too long. The second rule is frequency reduction before strategy change. When markets become violent, the temptation is to trade more because price is moving everywhere. That impulse is exactly what volatility punishes. Instead, I trade less. I raise my standards. I require clearer structure, cleaner levels, and stronger confirmation. If my normal setup appears 10 times a week in calm markets, I may only take 1 or 2 during high volatility. This protects me from noise masquerading as opportunity. In volatile markets, activity is cheap, clarity is rare. Next comes portfolio-level exposure control. In volatile environments, I stop thinking in terms of individual trades and start thinking in terms of scenarios. If the market drops sharply, how many of my positions lose together? If volatility spikes further, where does pain cluster? I cap total exposure so that one macro move cannot damage my account disproportionately. This often means holding fewer positions than feels efficient. Efficiency is a luxury of calm markets. Survival is the priority in volatile ones. Stop losses also need adjustment, but not in the way beginners expect. I do not tighten stops in volatile markets. I often widen them slightly and reduce size accordingly. Tight stops get shredded when price jumps. Wider stops with smaller size absorb noise without breaking discipline. This feels counterintuitive, but it respects how markets actually move under stress. Risk is controlled by size. First distance second. Another critical rule is hard drawdown checkpoints. I predefine what happens after a certain loss daily, weekly, or over a cluster of trades. At these checkpoints, action is mandatory, not optional. Size comes down. Trading pauses. Review begins. Volatility accelerates drawdowns, and without these circuit breakers, emotional decisions creep in fast. These rules are not pessimistic. They are professional. They assume stress will impair judgment and plan for it. Expectation adjustment is just as important as mechanical rules. In volatile markets, I expect lower win rates, wider swings, and uneven outcomes. I lower profit targets and lengthen evaluation windows. This prevents frustration from building when results feel chaotic. When expectations match conditions, discipline holds. When expectations are mismatched, even good decisions feel like failures. One of the hardest but most powerful rules is permission to do nothing. In extreme volatility, not trading is often the highest quality decision available. I learned to define conditions under which I am not allowed to trade, no matter how tempting the move looks. Major news releases, illiquid sessions, erratic headline-driven swings. Cash in these moments is not fear. It is optionality. Optionality is priceless when volatility is high. Finally, I separate volatility response from ego. Volatile markets create narratives of bravery and decisiveness. Traders feel pressure to act, to be bold, to take advantage. I remind myself that the market does not reward courage, it rewards alignment. The goal is not to be right during chaos, it is to still be here when chaos subsides and opportunity becomes tradable again. Looking back across every volatile period I've survived, the pattern is always the same. The traders who last are not the ones who trade volatility aggressively, they are the ones who respect it early. They size down before they are forced to. They slow down before damage accelerates. They protect capital and confidence so that when volatility finally contracts, they are positioned mentally and financially to participate. That is Risk Management 101 in volatile markets. Not prediction, not heroics. Preparation, restraint, and automatic rules that activate when emotion is most likely to fail you. If this lesson resonated with you, I invite you to subscribe to the channel so you can continue learning from lived market experience rather than reactive instincts, and leave a comment sharing the one risk rule you will enforce the next time volatility spikes, because deciding that rule now, while calm, is exactly what protects you later when calm is no longer available.